The broadcast is now starting. All attendees are in listen-only mode.
Good evening, Marshall Reddick investors, and thank you so much for joining us tonight for our webinar on 1031 exchanges. We are really excited to have everyone joining us tonight, and without spending too much time here on for you, grab your popcorn and your soda and let's dive right in. We'll get started. All right, so my name is Kristen Tabar. I am a real estate advisor and realtor here with Marshall Reddick Real Estate. A little bit of stats about me here on your screen. I'm not going to read those because I'm hoping that since you're all joining us tonight, you can already read. But I have been with the company about 4 years now. My husband and I did start as investors before I had the great privilege of joining the team. So I do get to proudly say that I practice what I preach. And my husband and I own property in 4 of our Marshall Reddick markets and actually use the same teams that we refer to our clients here on a daily basis. So happy to always share my experience with all of my clients and anyone here on the call tonight. If you have questions, please don't hesitate to pop them into your little question panel. And we can try to answer as many as we can as we go along. And anything that we don't get to tonight, no worries. We will make sure that we follow up with everyone to ensure that you get all the details and info that you need. So hopping right along, for those of you who are new to Marshall Reddick tonight, maybe joining us for your very first webinar, we are a full-service brokerage, a property management company, and a private lender with our headquarters right here in Newport Beach. We help our clients through the entire process of purchasing and owning rental real estate. So from the initial consultation where we discuss your goals and your strategy, through the acquisition, through the management, and we really are a one-stop shop for our clients and pride ourselves on being able to take care of everyone through the life of their investment. So we offer all of those services for our buyers and our sellers, and of course our lenders and borrowers as well. And as you guys can see on the screen, that includes not just your real estate agents and management teams, but also our connections with our vendors that we've built over many, many, many years, including CPAs, insurance providers, and of course 1031 exchange accommodators, who we're going to hear from tonight. So these are our markets that we're currently in. We are in 16 markets across the nation. The red boxes that you see outlining our Marshall Reddick offices. So here in California, in Clarksville, Austin, and San Antonio, we have Marshall Reddick offices, and in all of our other markets, we work with third-party teams that we've partnered with in order to help our clients to successfully purchase real estate. So we've carefully selected these markets based on several criteria, including the economic diversity and the strength of the economic growth, the states being landlord friendly, and I'm sure some of you out there who own California property are shaking your head saying, but Kristen, California isn't landlord friendly. You are right, but it's our home state, so we are very enthusiastic about buying and selling inventory here. The other states are landlord friendly. You will find that the rights, pardon me, my voice is a little scratchy tonight. You will find the rights on the side of the owner. You know, we look for strong rental demand. We look for good growth in the area. So these are the markets that we currently invest in, where we have strong teams and help our clients to invest. So how do we help? What does that look like for our clients? We, as advisors, work with our clients to set up consultations where we go through a series of questions, including your goals, why you're investing, how you plan on purchasing, when you plan on making offers and ultimately closing on your escrow, what your individual investment criteria looks like as far as market selection, number of doors, number of stories, bedrooms, condition, age, things to that nature. So a lot of time will be spent there. And then finally, the who. And the who is going to be introducing you to all of the key players that are going to be a part ultimately of your investment strategy. So what we do as a company is we, as I mentioned, go through all of these criteria and ultimately set up a map that you can follow towards achieving your investment goals. So what might that look like? It might look something like this. So this is my and my husband's own personal investment portfolio. And what our strategy has been is to purchase a property about every 12 to 18 months. And you will see along the path, we did do a sale. We've done some loans, so there's some diversity there. And this is made possible through careful planning and deciding what we wanted to purchase, when we wanted to purchase it, and then of course making decisions along the way to accomplish all of those goals that we set for ourselves. So ultimately what we want to do is we want to build a strong portfolio. And as part of building a strong portfolio, sometimes after owning a property for many years, you'll find that the value has increased significantly. And as you've been paying off your mortgage, you notice that, wow, I could sell this property and walk away with $60,000, $100,000, $200,000. And the big question is now, what do I do with those funds? And so tonight, we're going to have our 1031 accommodator join us for a presentation. We're going to walk all through the ins and outs of what's called a 1031 exchange. And basically what that is that's your way of selling your rental property and using the proceeds to purchase different rental property, meanwhile deferring your capital gains tax. So before we jump into the main event, we're going to take a quick poll here. And what we want to know is which of the following best describes you. So completely confidential. I promise I'm not going to post the results on the billboard as you drive down the 405. This is just to kind of give us an idea of who is listening tonight so that we can make sure that we're really addressing everybody's needs and wants as we go through. So which of the following best describes you? I have property with equity I'm considering selling. I own property but not yet in a position to sell. I'm in escrow on my property and would like to perform an exchange, or I don't own any property yet and I'm here to learn. I've been talking for quite a bit, so usually at this point I'd say I'll give you a few more seconds, but I've got most of the votes in already. So thank you very much everyone for being quick on the trigger here. So we'll close that and let's share our results. So about half of you are considering selling a property that might have a significant amount of equity. So you've come to the right place, and we will definitely get all of the information out there for you. 23% own property but are not quite in a position they feel would be lucrative to sell, and 23% of you are just here to learn. So thank you guys all very much for participating. I really appreciate that. And without further ado, we're going to jump right into the main event. So as I mentioned, we're going to have our preferred 1031 accommodator on the line tonight. Her name is Dino Champagne. She's been a partner with Marshall Reddick for, we were just talking about this, just shy of about 20 years now. She's been in the business a very long time. She is an expert, my friends. If there's any question you have about a 1031 exchange, she is our go-to. Very responsive. Her teams are excellent, and she's local here in Torrance as well. So we have clients that are able to meet her in person, meet her via telephone or at our events. And without further ado, Dino, it's my pleasure to hand it over to you.
Well, thank you, Kristen. Good evening, everyone. And it's my pleasure to talk about 1031s. I do this all day long, so I'm just continuing the momentum. First, what I want to do is just bring a little bit about the purpose of a 1031, and we're going to get into certain aspects as to, you'll see the numbers as to why people do them. But it's an excellent vehicle for someone that owns investment property to be able to utilize the funds instead of giving the tax dollars to either Uncle Sam or, for those in California, Uncle Gavin. They can use those funds and to purchase more. So the 1031 is a very, very good vehicle for this. We're going to go through the guidelines, and I'm going to take you through the tax ramifications if you sell and then purchase, or if you do an exchange. So we're going to go through all of that this evening. You only have this webinar for an hour, so I may give you just enough information to be dangerous, but please feel free to ask questions as we're going along, and or at the conclusion, you'll have my contact information. Do not hesitate to give me a call. All right, so let's talk about the tax rates when we're dealing with an exchange. So if somebody is selling an investment property, there are 4 potential taxes that they'll be faced with. Now, when you own and operate investment real estate, there's this lovely thing called depreciation. So for those of you that already have real property, you know what I'm talking about, which means that as you're receiving income from the property, you're lowering that income through the depreciation. So in other words, that's a non-cash expense that lowers your taxes as you're operating the property. Regrettably, when you go to sell the property, there is a tax associated with that, and that's called the recapture tax. So that is taxed at 25%. So whatever you've been depreciating, that figure is going to be taxed at 25%. Then there is the capital gain tax. Now there are 2 capital gain tax rates. There's 15% and 20%. So if your income levels are, and they just changed this with the Tax Cuts and Jobs Act, they increased the delta, if you will, to when you trigger the 20%. So if you're a married couple and your income is more than $459,000, you're going to be in the 20% tax bracket. If it's below that, then you'll be in the 15% bracket for capital gains. And I'm going to give you the caveat right now. I can't recall the single taxpayer. It's slightly under. I want to say it's maybe around 425, something around there. But don't hold me to that number. I'd have to look it up. But if your income exceeds that, then you'll be at the 20%. If it's below that, you'll be at 15%. Now, there is an additional tax. It's called the net investment income tax. And what that tax is that's a tax that's a result from the Obamacare bill, the health care bill. So if a taxpayer is selling an investment piece of property and they're a married couple and their income exceeds $250,000, they will pay an additional 3.8% for the net investment income tax. If you're a single taxpayer, then it's $200,000. So if your income exceeds that, then you'll pay an additional 3.8. If your income is below that, then you will not be subject to that additional tax. Then for those in the state of California, or those that have property in the state of California, there's the California state income tax. Now, the California tax does not have a long-term capital gain rate. It's just ordinary income. And the tax rates for California currently range anywhere from 9.3% to as high as 13%. So when somebody is selling an investment piece of property, these are the taxes that they're potentially subject to when they sell that property. So what I'd like to do right now is give you an example of what these taxes might look like in a scenario. So for example, you always start off, what is my basis in the property? Well, if you're just buying the property outright and you have not done an exchange, your basis is going to be basically what you paid for the property. Now, if you make any capital improvements while you're operating the property, technically you can't write those expenses off, but you can add them to the basis when you go to sell the property. For example, if I have to put in a brand new air conditioning, or if I have to do a complete new roof, while I have the pleasure of spending the money, I can't write those expenses off the year I spend the money. But when I go to sell the property, I can add those dollars to the basis in the property. So in my example here, saying that we bought the property for $500,000. Over the course of the ownership, we've made capital improvements totaling $50,000. Now the depreciation, there are two tables for depreciation. I don't want to get too deep in the weeds. So this is just an example, okay? But when you have residential income, you are able to depreciate the improvements by 27.5 years over the course of the time. So if somebody's owned a property for a long period of time, their depreciation could end up being pretty high for a period of time. So in my example, I'm showing that the depreciation was $150,000. So what I'm doing here is figuring out what's my net adjusted basis. So I bought the property for $500,000. I made capital improvements of $50,000. I have depreciation of $150,000. So my net adjusted basis is $400,000. So that's a figure that when I go to sell the property, I'm going to need to know. Now, the next section here, we're going to talk about how you calculate gain. So I sell the property and say my sale price is $1.2 million. My net adjusted basis is $400,000. I'm going to have closing costs such as title, commission, escrow, transfer tax. So those fees I can subtract. So in this example here, we're saying that my closing costs were $80,000. So if I sold the property for $1.2 million, my net adjusted basis was $400,000, my closing costs were $80,000, my gain on the sale of that property is $720,000. Now that's not uncommon if somebody's owned the property for a very long period of time. But this is just to illustrate how gain is calculated. Now let's look at the tax ramifications on this type of gain. Remember I told you at the recapture, you're lowering your real estate taxable income while you're operating the property. So when you go to sell the property, there's going to be that tax. So because my depreciation was $150,000, that's going to be taxed at 25%. So there's $37,500 going for the recapture tax. Then there's the capital gain tax. Now the capital gain tax is going to be based on $570,000 because the depreciation is separated from the actual gain itself, even though it's referred to all the time as gain. So the capital gain tax is going to be only on the $570,000. So it's not like I'm being taxed twice. So because it's $570,000, I'm going to be in the 20% tax bracket. So that's another $114,000. Then there's a net investment income tax, which is going to be taxed on that. That's another $21,660. And then because the gain on this property is $720,000, this particular situation will fall under the 11.3% rate for the state of California. Remember, I said there's a range. So, and it depends on whether you're married, head of household, single, and the like. So in that situation, it's going to be 11.3. So that's another $81,360. So as you can see, while my gain was $720,000, I am subject to potential tax of $255,000. Now, let's show how this plays out in the real transaction. So if I go to escrow and sell the property, I'm selling it for $1.2 million. I pay my closing costs. If I have a loan on the property, the lender is going to require that that loan balance be taken care of before they transfer the title. So my loan, I have to pay off my loan of $500,000. So now, as an investor, I have $620,000 of actual cash left. If I were just to sell this property, not do an exchange, and maybe just go out and buy another piece of property, I'm going to have to earmark roughly $255,000 so I can pay the federal taxes as well as the state taxes. So that means that after I pay those taxes, I'm only going to have roughly $365,000 to put down on the next property. So if I were getting a loan 70% loan to value, my purchasing power is about $1.2 million, pretty much where I sold the property for. Now, if I want to do an exchange allows me to defer that paying the tax, that $255,000. Now I have the full $620,000 to put down on a property or properties. And this situation is 70% loan to value. I can now buy a piece of property for $2.1 million. So this is what we call the power of an exchange. So as a taxpayer, I have the opportunity to defer the tax as long as I would like, and therefore using that money to buy more property to help build my portfolio. Now, in anything we do, there's always pros and there's always cons, okay? So let's talk about the pros of doing a 1031 tax-deferred exchange. Well, the first pro is what I just described. I get to defer the tax. I get to defer the depreciation recapture tax, federal long-term capital gain rates tax, state taxes, the net investment income tax, okay? So I get to defer all of that. The next the pro to doing a 1031 is wealth accumulation. Well, I get to preserve my equity because why? I'm not paying the taxes to the federal government, to the IRS, and or to whatever state I'm in, be it California or whatever state has an income tax. I also have an opportunity to leverage. Now, there's times where somebody might own a property, like in the example here, we had 1.2 million, right? And the loan was only 500,000, which is relatively, it's less than 50% loan to value. So I could theoretically go out and get a loan for 70% and then get property for 2.1 million. So I get to use leverage in a 1031 so I can buy more property. Options also with the pros of doing a 1031 is diversification. I can diversify by location. So if I want to sell in California, I can go buy in Tennessee or Texas or Florida. Okay, I can go elsewhere within the country. I can diversify by asset class. So if I have an apartment building, I can go out and buy a single family rental. Or if I have a retail center, I can go buy maybe a single tenant triple net type property. So I can diversify not only through geography, but also by asset class. And we're going to talk about like-kind a little bit later. And then the other pro to doing an exchange is that I can possibly exchange into something that's easier to manage, like a single tenant triple net or a Delaware statutory trust. And then there's another component that is still in the tax code. So we're fortunate that this did not get eliminated under the new tax laws, is that if I sell a property and I do an exchange and I keep exchanging until I meet my maker, then when I pass away and my heirs receive the asset, they get a full step up in basis. So that means that any gain that I have been deferring over all those transactions is forgiven to them. So that's one of the pros of doing an exchange. So some people will use it as an estate planning tool. Now, with every pro, there's going to be some cons. So let's talk about the cons to doing a 1031. Well, there are certain rules that you have to follow. They're very specific and there are time restrictions. So that's one of the challenges to doing a 1031. Another challenge about the 1031, as opposed to just buying the property, selling the property, paying the tax, and buying the property, when I do an exchange, my basis is going to go with me to the next property. So, for example, if I'm selling for $1.2 million and my adjusted basis is $400,000, then my new basis, if I buy for $1.2 million, is still $400,000. So I don't get a brand new basis in the property. So that's one of the downsides to an exchange. My basis and my gain both move with me to the next property. A lack of liquidity. And what we mean by that is the fact that I have to buy real property. If I touch any cash that I keep, I will pay tax on. So when I'm doing an exchange as an investor, all my money needs to move with me to the next property. Any money that doesn't, I will pay tax to the amount of gain recognized. If I have losses and I do the exchange without consulting my tax advisor and I don't know I have these losses, I can't recognize those losses on this transaction. So you always want to consult your tax advisor when you're making a decision about selling and doing an exchange. There's always the risk of potential higher taxes in the future. And as said, it's tax deferral. There's nothing tax-free about the 1031. So those are the pros and cons of doing a 1031. Now, you have requirements that you have to meet when you're doing a 1031. And one of the major requirements is that you have to have a qualified intermediary. And that's my function in the transaction. So when somebody's selling investment property, you're going to have, you know, like Kristen with the real estate side of it, you're going to have escrow, you're going to have your lender, but then you're going to have the qualified intermediary. Our role is we have a written agreement that we enter into with each individual or company that's doing an exchange. So basically, we become the seller of that property. So prior to your escrow closing, and I want to make that very clear, the exchange must be set up prior to your escrow closing. If you do not set up an exchange and you close without one, you do not have an exchange. There's no do-overs, resets, mulligans, or anything of that nature. It's already a taxable event. So the role of the qualified intermediary, through our documents, we basically acquire the relinquished property, so technically we become the seller. We have instructions contained within our documents telling the closing agent or the escrow officer to deed the property directly to the buyer. See, in a forward exchange, we don't have to go on title to the property. All of this is done through our documents. Then when it comes to the replacement property side, then we have to be assigned into that agreement because now we are the buyer of that property, okay? And then very important language that's included in the exchange agreement itself, and that would be the language that restricts the taxpayer from touching their funds. As somebody doing an exchange, you cannot have access to your funds. So the role of the qualified intermediary is to become the seller of the relinquished property, have direct to buy the next property. Kristen, you want to flip the slide?
Is this the one you're on or the next one? Sorry, Dino.
Sorry, I already went to the next one. I already went through it. So flip to the next one.
Are we at like-kind property?
I'm not seeing it, so it's not coming through on my computer. So where are you?
Oh, I'm at like-kind property.
Oh, yeah, you're way too far ahead. Okay, so, yeah, okay, all right, so I'm going to be doing this in the blind here. All right, okay, so the code, we went through the tax code itself, right? So the code itself, so you want to flip back to the code?
I am on the code. Can everyone
Okay,
watching,
yeah.
Can you just give me a quick note that you can still see my screen, please? All right, Dino, go ahead. We're on the code.
Okay, yeah, I'm still not there, but that's okay. All right, so what allows you to be able to defer the taxes, because it says that no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such property exchanged solely for real property of like kind, which will also be held for trade or business or for investment. So when you're talking about doing an exchange, the property that you're selling and the property that you're purchasing must be property that you intend to hold for investment purposes, okay, or your trade or business. But this is an investment group, so we're probably talking more about investment property, okay? Now, when we talk about that, when we talk about holding periods, all right, one of when we talk about holding periods, there's nothing in the code that mandates how long you have to hold the property for it to have been held for investment purposes. So anytime somebody is considering an exchange, it's, as I mentioned earlier, it's so important to talk with your tax advisor, because if your intent is to fix the property and flip it, then that technically does not qualify for 1031 by virtue of the fact that you do not intend to hold the property for investment purposes. So there are two schools of thought on the intent to hold. The one perspective would be that you hold the property for at least 24 months, because that should season that you really intend to hold this property for investment purposes. There was a revenue procedure that came out back in 2008 that addressed vacation homes and how vacation homes could potentially qualify for a 1031. And in that revenue procedure, it outlined that the taxpayer needs to hold the property for at least 24 months. So that can give some kind of an indication that 24 months may be sufficient. Now, some tax advisors may feel that a year is sufficient because if you've held the asset for more than a year, then generally speaking, you'll get long-term capital gain rates. But it's about your intent as a taxpayer doing an exchange. So always consult your tax advisor to determine whether you did, whether he or she feels that you qualify for doing an exchange. Okay? So holding period is very, very important. That word intent is very important when you're talking about doing a 1031. Okay, now, when we talk about investment property for investment property, we're getting into the like kind. And this is where sometimes, even in today, after all the information out there about 1031s, where people still get a little confused. So if I am selling an apartment building, I can go and buy an office building. I can buy single family rentals. I can sell my raw land that I've held for investment, and I can turn around and buy some income producing property. So just to say again, when we're talking about like-kind property in a 1031, it must be real property, and it must be property that you intend to hold for trade or business or for investment. So as you can see, like-kind is very, very broad when it comes to 1031. So a couple of requirements so far that we've talked about. One, that you must have a qualified intermediary. Two, that you have to exchange for like-kind property. Now, one of the third requirements for doing a 1031 is that you need to spend, when you're doing an exchange, you have to spend all of the cash coming out of the sale. You need to replace any existing debt. So in other words, you have to buy property equal to or greater than your net sale price. So in my example here, we're selling for $900,000. There was a loan of $300,000. We have closing costs of $60,000. So that means the cash coming out of the transaction will be $540,000. Now, I go to my purchase, and if I'm buying something for $1.2 million, if I put down the full $540,000, I can get a loan for $660,000. I have met my exchange requirement because I spent all of my cash and I bought property equal to or greater than my net sale price, which in effect replaced my existing debt. So in this example here, you can see that there would be no boot. And when I talk about the term boot, that means taxable in the 1031 world. Now, sometimes people want to maybe buy something less than what they sold for. So if I have a property that I'm selling for $900,000 and I buy a piece of property for $700,000. At this point, I'm not spending all of my cash and I'm not replacing all of my debt. Chris, is that slide up? There it is.
Yes.
Okay. Okay. All right. So in that situation, I have, because I did not spend all of my cash, I have $100,000 of what we call cash boot. And because I only received a loan of $260,000 and I had an old loan of $300,000, I did not replace my debt. I have taxable boot to the amount of $140,000. Now, sometimes people get a little concerned and going, well, wait a second, why do I have to pay tax on the $40,000 when it's not money I ever received? When you stop and think about what a loan actually is, a loan actually is the money that somebody else gave you to buy the property. So in effect, a loan is money, and it has to be replaced when you're doing an exchange. So you have to be very careful that you're making sure that you're replacing your debt and or you're not getting too much of a loan where you're keeping too much cash and make the mistake of thinking you have a full taxable event when in effect you don't. Now, I just want to touch a little bit about the debt aspect of it, because it does get a little, people do get a little confused. Sometimes they go, if I only have a loan, say for example, of $50,000, okay? Well, it's hard to find a lender that's going to lend on for $50,000, but if I have cash in my savings and I bring in that extra money, then I did replace the loan. So when we talk about replacing a loan, there's two ways to replace the loan that you had relieved on your sale: by getting a new loan or by bringing in cash from outside of the exchange to replace that debt. So it's important to understand that you don't have to physically go out and get a loan if you're buying equal to or greater than, and you have the cash outside of the exchange to make up the difference, okay? Now, when we get to the closing costs for exchange, there are certain expenses in a transaction that are considered exchange expenses and therefore would not be considered boot. Real estate commissions, the title insurance, because when you sell a property, typically the seller pays the title insurance. The closing fees, such as the attorney's fees or the escrow fees, any other legal fees that you might have, transfer tax, the recording fees, the qualified intermediary fees. Those are some of the costs that are considered acceptable exchange expenses. But there are going to be expenses in a transaction which may not be considered exchange expenses, and you may end up paying tax on. So let's kind of go through that list a little bit. If you have, for example, prorated rents and security deposits on a property that you're selling, you'll see this more when you're selling like an apartment building or when you're selling a retail center or something along those lines. Not so much when you're selling a single family rental, because generally the person buying it, and most of my experience has been, they're going to be living in it. So that's not going to be an issue. The tenant's usually not staying with the property. But if I have tenants in there and there's prorated rents and security deposits, it's not uncommon for buyers and sellers to say, well, just credit me that. Well, if I'm selling a property and I've got $10,000 worth of prorated rents and security deposits, and I'm telling the buyer, I'll credit you that, that's a boot issue for me as a seller, because the buyer's not bringing in that $10,000. I don't want to get too deep in the weeds, but there are certain things that are not considered acceptable expenses: prorated rents and security deposits. When it gets to loan points, prepayment penalties, that's a function of finance, not a function of transferring the property. Not uncommon to see a seller paying for the buyer's closing costs. Well, that's not technically an exchange expense and could be considered boot. Lender policy for the title insurance, that again would be potentially boot. Any impounds, property taxes, insurance. So these are costs of actually either financing the property or operating the property. So they don't technically qualify as exchange expenses. So you want to always consult your tax advisor so you know what you are going to be faced if you're dealing with these issues. Now, okay, so what steps to take prior to the exchange? Always consult your tax advisor, always. And hopefully you have a good tax advisor that understands real property and or 1031. That's the individual that's going to tell you whether you should or need to do an exchange. Then you consult the qualified intermediary. We're going to have different conversations than what your tax advisor is going to have with you. Your tax advisor is going to run the numbers and they're going to say, okay, Joe and Jane, your gain on the sale of this property is about $100,000. You're probably going to pay somewhere around $30,000 in taxes. If you don't want to pay that, then maybe you should do an exchange. Then the qualified intermediary, what we're going to talk to your client about, what we're going to talk to you about is what our role is. We're going to go through the time frames of the exchange, going to answer questions, explain what the process is going forward, and then so you have a good idea of what you're about to go into. And then another thing that's really important is you want to confirm, you want to make sure that your title is matching how you're doing your tax reporting. And I know that sounds silly, but I can't tell you how many times in a transaction where maybe somebody owned the property in their individual names, and then they created a partnership, but they never bothered to change the title. So the title has to match the tax ownership. So important to make sure that however you're showing on title is actually how you're reporting the property on your tax returns. And then, you want to make sure that your purchase and sale agreement matches everything. Okay, so these are the steps that you're going to take before. Now, you get the property under contract, you open up escrow, okay, so you have a buyer and seller, it's opened up. That's when the qualified intermediary's role will officially begin. At that point, I would reach out to whoever's handling your closing, okay, if it's an attorney or if it's an escrow, I would be requiring certain documents from them. I would ask the escrow officer, for example, to give me a copy of the fully executed purchase and sale agreement, the title work, their instructions. They would send that information over to me. Then at that point, then my processing team prepares the exchange documents. The exchange documents are then sent to the escrow officer or the closing agent, and they're sent directly to the taxpayer. This is how we do it. It may vary from company to company. But it's important that you sign those documents prior to the closing of the sale and return the signature pages either back to the qualified intermediary or back to the closing agent. When they close, the closing agent will then deed the property directly to the buyer. The cash will now come into the qualified intermediary, and now the time frame is going to start for your exchange. So that's the next requirement we're dealing with. So we've got getting the qualified intermediary involved. We talked about lifetime property, and then we talked about the exchange equation. So now we're talking about the fourth requirement, the timing for getting the exchange completed. You have 180 calendar days from the date of closing to close and complete your exchange, but within the first 45 days of the 180-day period, you have to identify any property or properties that you would like to acquire in the exchange. I'm going to go through the identification a little bit later, but I just want to give you the timing. These time frames, there are no redos once they start. The only time that there's ever any extensions to either the 45 or the 180 days is if there has been a presidentially declared disaster and you are affected by it. Other than that, any other reasoning why it can't close is not an excuse to get an extension, because there are no extensions. These time frames are statutory. Now, when you go to buy the replacement property, the qualified intermediary, we have to know that you're under contract with something. We're gonna prepare the exchange documents. You're gonna sign those. You're gonna sign the request for funds form. Then we're gonna wire the funds into the closing, and then the deed will go directly in your name. So that's sort of the cycle of the exchange. Now, let's go fine-tune the identification, because the most challenging part to any exchange is going to be the identification period. Now, there are 3 rules that you can utilize, but you can only choose one of the 3. The most commonly used rule for doing an exchange is the 3-property rule, which means that as a taxpayer doing an exchange, I am physically limited to 3 addresses. I can pick 1, 2, or all 3 to buy, okay, but I'm physically limited to 3 addresses. But I'm not limited to the dollar amount. So in other words, if I'm sold for, $1 million, I can identify one property for $1.2 million, another property for $1.5 million, another property for $2 million. And at that point, I can buy either, any one I want, okay? Now, people go, well, can I identify more than 3 properties? Well, maybe. Now, if you want to identify more than 3 properties, now you're going to default to the next rule. And the next rule is the 200% rule. So under the 200% rule, you can identify 4 or more addresses. Now, the dollar amounts, however, are going to matter. So under the 200% rule, when I put down, say, 5 or 6 or 7 properties, when I add up those properties, it cannot exceed 200% of my sale price. So if I sold for $1 million, I can identify, put down on my list 5, 6, 7 properties, as long as when I add them up, it doesn't exceed $2 million. And then I can buy whatever combination I want. We see the 200% rule used when people are selling in high valued areas and they're spreading their money around, if you will, to various states. So if you're going from, say, for an example, an apartment building and in Southern California, and you want to buy single family rentals, then you could potentially buy a whole bunch of them, okay? And at that point, you can use this rule easily. I had an exchange where somebody identified, 25 properties, and they fell within the 200% rule because they sold a high valued property. But if you're selling something for around $300,000, it's hard to use anything other than the 3-property rule by virtue of, you know, the price point of where you're selling at, okay? But unless you're going into an area where maybe the values are under $100,000. So you have to watch this very carefully. Now, if I identify more than 3 properties, but my fair market value exceeds 200%, I have now defaulted to the 3rd and final rule, which is the 95% rule, which is unlimited number of properties, unlimited dollar amount. But I have to buy 95% of the total of all the properties I've identified. So I like to call this the all or nothing rule, because in effect, you have to buy all of the properties. Very, very risky rule to ever use. And very few people ever use that rule. So most people stay within the first 2 rules for the identification. Now, here's an example of what the identification form looks like. Okay? It's basically, most qualified intermediaries are going to provide you with a document. It's something that we provide. But you're going to fill out the addresses, the city, the state. You're going to sign it, you're going to date it, and you're going to send it in by midnight of the 45th day. Now, that's the technical aspect of the exchange. But sometimes people will ask, well, do I have to be under contract? Is that a proper identification? And the answer to that is no, the code does not require you to be under contract with the purchase. But from a practical standpoint, you should be, because you can only purchase what's on your list. So most of the people that are going to do exchanges fill out their identification form when they get closer to the 45th day, because if you're making offers on various properties and some of them you're not going to buy after you've done your due diligence, you're not having to concern yourself with the formal revocation of the list and then replacement of the list. So it gets very, very tricky for the identification. This is the hardest part to the exchange, I have to tell you. So from the practical side, you should be under contract with something. From the technical side, it's actually not required. Okay? So the next thing I want to highlight about the identification is, in order for it to be a valid ID, okay, next slide, Kristen, is that
identification
if you,
rules and requirements.
yeah, yes, that you got it. So if you don't properly identify the property you've gotten in exchange, so if you're not properly identifying it, then it's considered non-like kind in an exchange. There's certain variances that you can have. If I identify a property, say for $1 million, but I end up getting it for $600,000, not very rare this happens, but if I identified for $1 million, but I only bought it for $600,000, then it's not considered substantially the same, so would not qualify. If I am purchasing a portfolio of properties, then I have to identify each and every property in that portfolio, although it may be one purchase and sale agreement. And then you have to revoke and replace a list. So there's formalities to the identification. Very, very important to understand that the identification is so critical to the success of an exchange. And if I happen to be purchasing with somebody else as co-owners, not as in a partnership, but co-owners, I'm going to be identifying a percentage, not the full property, because I'm not buying the full property. So my point in the identification, we spend some time on this because that is a key to a successful exchange, is making sure that you're identifying property, making sure that you have a good enough plan that your exchange will be successful at the conclusion. Okay? Now, sometimes people will ask, okay, well, if I sell one property, well, what if I wanted to sell multiple properties? Can I sell multiple properties to buy one property? And the answer to that is yes. We do multiple property exchanges all the time. But what you have to be aware of, so if you're an investor that has a portfolio, you know, have some properties, and say you want to sell one in Texas and one in Nevada and one in Alabama, okay? And you want to put those 3 properties to buy one big property in Tennessee. Well, the challenge that you're going to be faced with is making sure that all of these properties close as quickly or as close together as possible, because when you close on the first property, at that point, the timeline for the exchange begins for the second as well as the third property. So you want to make sure that you get those properties closed as close together as possible. I've had a situation where there was a 4-property exchange. 1 property was in California, 3 were in Texas, and different cities in Texas. And they already found their replacement property. So they were under contract on the replacement property, and they were looking to consolidate those 4 properties to buy the 1. And in that situation, we had 2 under contract, but the 2 others were not. Fortunately, they were able to get the other 2 properties under contract with the buyer, close on all 4 of them, so then they can close on their replacement property. Okay? So the funds all came into the qualified intermediary, and then when you were ready to close on the purchase, you want to flip the slide, Kristen? When you're ready to close on the purchase, we're holding all the funds. Okay? So that's how the multiple property exchange works if you're selling multiple properties and you want to buy 1. Now, on the other side of the coin, where somebody's selling 1 property and buying multiple, that happens all the time. That's not as hard to control. It's harder to control when you're selling multiple than when you're buying 1. Now, but it is important if you're going to be buying multiple properties and there are different parts of the country and you have different lenders, just to make sure that you can get these loans and everything closed in time to meet your exchange requirement, because you still have to finish your exchange within 180 calendar days. So we see multiple property exchanges all the time. They're doable, but you just have to have really excellent planning to make sure it's going to be as successful as possible. Okay. Now, just a couple of other issues about 1031s that we're seeing. In certain markets, there's low inventory. So that makes it a little more challenging. If you're selling, what are you going to buy? That's where Kristen's there to help you. Purchasing multiple properties and selling multiple properties, we just went over that. And so timing is very, very critical. It's important to make sure that when you're doing an exchange, and this is very important, because when you're doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. So we've had examples where somebody had a property and they had it in an LLC, and it was a husband and wife, but the husband and wife chose to have that LLC taxed as a partnership, and they were in a community property state. Well, when you're trying to find financing on a 1-to-4 for a partnership, it's difficult to find financing. Now, there's people out there, I'm sure, that will finance it, but it's not an easy request. So they thought that, and the lender, they thought that, well, okay, well, we'll just buy it in our name, and then we'll turn around and we'll put it back into the LLC, and our exchange will be good. Well, we as a qualified intermediary cannot release funds to a different taxpayer buying. So very important to understand what kind of vesting you have on your property, and then making sure that what you sold maintains the same vesting as when you buy. You can do partial exchanges. I showed you an example earlier. One of the key things about doing a partial exchange is you want to make sure that you're still benefiting from the exchange. So that how much cash you're keeping or you're not reinvesting is you're still protecting tax on any of the gain. So for example, if I'm holding out $100,000, but my gain is only 90, there's no reason to do an exchange. I will pay all the tax anyway. But if my gain is $200,000 and I'm keeping 100, I'm still protecting tax on $100,000. So my point to partial exchanges is you need to have the discussion to make sure you're still benefiting from it. Investors do exchanges, dealers cannot. So if you're buying property to fix and flip, that technically does not qualify as an exchange. You're considered a dealer at this point. There is a thing called a reverse exchange. Try to stay away from those if at all possible. They're very expensive and they're very difficult to do. So you want to make sure that if you're thinking about a reverse exchange, which basically means you have to close on your purchase before you have closed on your sale, you can't be on title to both properties at the same time. So the qualified intermediary creates an entity where we go on title to the property. That's where the expense comes in. But also the challenge is where do you get the money to buy the property? If it's a loan, then that makes it even harder for the reverse to happen. So try to stay away from those if you can. And then the other components, if you're selling in California and you're exchanging outside of California, there is a form that you have to fill out every year when you file your tax returns. It's the FTB 3840 form, because California has what's called a clawback provision. So what that means is if I sell a property in California and I exchange to Florida, I didn't pay California my taxes, right? So I exchange. If I subsequently move to Florida with my property, when I sell that property, I technically still owe California the tax that was due when I sold from California to Florida. So it's called the clawback provision, and this is their way of monitoring it. So there's certain things you want to be aware of. Now, the qualified intermediary, you want to do some due diligence. We're not a regulated industry, so you want to find out, how long have they been doing this? Where do they place the funds? What's the requirement for any kind of withdrawal, withdrawals or deposits? Are you monitoring this? Are the same people wiring the funds? Are they the ones authorized to sign the wire instructions? Are they audited internally, externally? Have they been, are they backed by a large parent company? So those are some of the things that you might want to take a look at when you're considering using a qualified intermediary. It's not just the fee that we charge. You want to just make sure that whatever, that you're doing what you're doing, you're going to have the funds and you're working with a firm that's going to have the experience. And, we've been doing this since 1990, done about 175,000 exchanges, and we're owned by $1 billion title company. So that's who we are. Anyway, I know this has been a lot in a short period of time. I can talk on this subject for another 3 hours. Your popcorn's probably run out by now. If not, your soda has. So anyway, here's my contact information. If you have any questions, please feel free to reach out.
Thank you so much, Dino. It was such a pleasure having you on tonight. I always love doing this presentation with you. There were a few questions that came in as we were going through the presentation, but you did hit a lot of those as we continue to go through.
Okay.
So I want to just this one just came in from Lisa. We have a couple of minutes. Does the clawback in California still apply if you owned a property until you die?
No.
All right. So Lisa, hopefully you're still on and you caught that.
Yeah, no.
Everyone else.
No. Yeah, go ahead. I'm sorry.
Everyone else, if you have additional questions, please don't hesitate to reach out to Dino directly or myself. My info will pop up in just a moment. We're going to go ahead and get through the rest of the slides here and get you guys off to get more popcorn and soda or perhaps dinner. So now what? Now is when you are having the conversation with your CPA or, your qualified intermediary, maybe your agent, decide whether selling is a good idea. Maybe you're not at that point yet. Maybe you just want some more information. The Marshall Reddick website has a learn page full of educational material. This presentation is also currently being recorded and will be posted tomorrow. So I know it's a lot of info to digest, and you are able to circle back and re-watch and pause and otherwise re-listen so that everything is definitely clear and makes sense. And these are going to cover market data, any presentations we do on specific markets, basically any topic that we cover with all of our vendors and all of our service providers. You can find anything real estate related on that Learn page on our website. If you're looking for replacement property and you're not sure, Dino mentioned property class a little earlier in the presentation. We are big on property class as well, want to make sure that each of our investors are choosing the right investment for their particular needs. So our property rating ebook is a free download, and you can also find that on the Learn page on our website and all of the properties as well. So if your next step is doing some more research, you can find it on the Marshall Reddick website. If your next step is so that you can learn more, get started, take the next steps in your investment strategy. Here is my information. I can be reached via telephone or email. That's my cell, so please feel free to text also. I know a lot of us are busy and it's difficult to talk sometimes, especially if we're parents and have children at home. I know sometimes I'm not able to answer the phone, but I can certainly shoot a text message. And you can also schedule that consultation online as well. So any step of the process that you're currently on, we can assist, whether it's getting started, getting the property listed, or if you're ready to start with the exchange and you're ready to talk situation, we are here to help. So once again, I want to thank everybody for joining us. It is 7:31, so I'm officially 1 minute over my time slot. So thank you guys for sticking with us. And again, if you still have questions coming in, please know that we will make sure to reach out to you and get those questions answered. I'd like to give one more warm thank you to Miss Dino Champagne. Thank you very much.
Thank you, Kristen. I appreciate the opportunity.
And everybody have a wonderful evening. We'll see you next time.